Hi everyone, my name is Piterpakulski. Today we are answering another very interesting and important question. What is the payback period of our business idea? So in this series of videos we are building Uber, Lyft, taxi financial model for this business idea. We are doing it from scratch. Give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video, I will give you the link to the playlist where I will be keeping all these tutorials. And when I completely finish this model, I will give you all the links on tutorials how I created this model from scratch in the description of this video as well. So you may watch for free all the path from scratch how I created this financial model. What is important to know about the payback period? So you can't calculate payback period without doing some preliminary action. So first of all, we need to gather all our revenues, direct costs, fixed costs, payroll, taxes, investment plan, financing, the way we finance our business idea. Then we need to build cash flow statement, and only having done the cash flow statement we can focus on calculating the payback period. So this will be the topic of our today's video. This will be a very interesting journey. First of all, let's briefly I will show you what we did before. So we have a model where all our inputs are colored with blue. So we have, let's have an example. We have 5 cars in our fleet. So we have different types of trips. So here is the mileage of these for these trips. This is the duration of these trips. Revenue per trip, we can switch them on and off. So we have different coefficients for mileage, for duration, for revenues, for scenario modeling. So then we specify how many trips we have on Monday, Tuesday, Wednesday, Thursday. So we are specifying the portrait of the from Monday to Sunday. So we can switch on and off different types of trips from calculations for a specific day. We can switch on and off different days from calculations inside a typical week. We have the coefficients for the amount of trips per day. Inside the typical week, we can set up limits for the daily mileage, for duration of our car being online. This is some kind of control panel to make us be living in the world of realistic numbers. Then we specify how fast we are reaching the target revenues. Then we start describing our car. So what will be the mileage when we will be selling this car? What is the price of a new car? What is the prices of an old car when we are selling it? What is the down payment for the leasing? What is the interest rate? What is the term of leasing of loan? So then we start talking about dealership maintenance. Here is the mileage on the odometer. Here is the expenses. Here are the expenses. These are parts for the car, and we can play with all these types of costs, so dealership maintenance and parts. So we can increase and decrease these types of costs. Then we create the investment plan for this specific car. Then we take into account fixed costs. So this is the typical. This is the typical year. We can switch on and off different costs. We have local and global coefficients for fixed costs. Then we are talking about gasoline, commissions to Uber and Lyft, payroll, driver's payroll. Then we consolidate all the revenues and expenses from this one car and put it on the next tab. Here we can name our cars, 5 cars, 1, 2, 3, 4, 5. We can switch them on and off from calculations. We can set up when operating activity of each car starts. We can choose the way we would like to finance each car, whether it is a loan or leasing, or this will be our own funds. Then we have a switcher for management company. We can switch it on and off. This is the management company payroll. This is the management company fixed costs. This is the management company investment plan. This is the loan, global loan for the business. We can look at it separately, or we can link this loan to the management company. So this is the amount of loan, interest rate, term of loan, grace period for principal payments and loan payments. This is the moment when we get this loan, if it is an independent loan. These are the tax rates, and this is the cash flow statement. This is the cash flow statement. This is the amount of financing that we've calculated. And now it's time for us to calculate the payback period of our business idea. So what we need to do, first of all, let me so you can do it quite easily. So let's create the timeline. Let's call it payback period calculation. Payback period step 1. So first of all, what we need to do, so we'll go to the cash flow statement. We will take the result from operating activity. This is revenues minus these are the revenues minus direct costs minus fixed costs minus payroll minus taxes. So this is the, so again, revenues minus direct costs minus fixed costs minus payroll minus taxes. This will be the result from operating activity, then plus the result from investment activity. This will be our investment costs with minus signs. Here they are. Then from financing activity, I'm taking only outflows, because if we add loan inflow and our equity, we won't be able to see, so we need to put equity and loan to avoid cash gaps. So in this formula we are taking only outflows from financing activity to make us be able to calculate whether the project itself can generate amount of cash equal or higher to the amount of money that we invested in it from different types, from loan or for equity plus equity. So we are taking minus sign and add down payment minus loan payment minus principal payment minus interest payment. And now we are pressing enter. Then what I'm doing, I'm extrapolating this formula to the right. Then I'm making this formula cumulative. So I'm adding the previous cell to this formula and extrapolating this formula to the right. And if we look at this, line, we can see negative values and then these negative values turn to positive values. So this is the moment when our project has generated the cash equal to the amount of investment that we put in it. So in June 2026 we are happy, finally. And we can also calculate payback period step 2. So we can calculate the amount of months for the payback period. So if this value is less than 0, we will put 1, otherwise 0. Now let's extrapolate this formula. Now let's create totals for this line. And now we know that the simple payback period for our business idea is 40 months. And what we can do, we can create a diagram for this for the payback period. So we can take this line. Let's first of all collapse the years. So now let's select this line. Then let's press insert, diagram. And this is our famous payback period diagram. So we can select this area, then select data, edit, and we can add this line for the description of this axis. So the moment of the payback moment is if we look at the diagram, the moment of the payback is the point when this diagram crosses the time axis. So this is the time axis, and this is the moment of the payback. And so this is the payback moment. And if we, for example, adjust some data, for example, we can go up, we can, for example, increase the pricing, for example, we can go back, we can see how the diagram is jumping. Let's decrease, for example, pricing. So for example, if we would like to take only 20% of current pricing, we will see what happens with the diagram. And so the payback moment is somewhere here. For example, let it be so May 2028, so we can go here. Here it is, May 2028, so when negative becomes positive. So what we can do when we start playing with scenarios, we can go up, for example, we can copy and paste this diagram here. Now we can link our loan to the management, for example, to avoid manual setting up the moment when we are getting the loan. So for example, this will be linked to the management company. Now it is linked, and for example, we can quickly build scenarios, for example, like what will happen to our business ID if we switch off, for example, the first car or the car number 4. So we can create different portraits of cars from perspective of revenues, expenses, and so on. So for example, if we use, for example, own funds, a loan, for example, lease scheme, we can, for example, what we can do, for example, we can displace our project, for example, September, October. We can, for example, set up a new car, for example, in 2024, February, for example. This car, for example, the next car will be February, March, for example, March 2024, for example. This will be 2023 August. So we can quickly create numerous amounts of scenarios and see what will be how much financing we will need in this or that case. So we can pull these values closer to the top of this, table diagram that I was showing you. So this is the value of the simple payback period, and we can create a simple dashboard taking this value, for example, net present value, discounted payback period value. So we will do it a little bit later, and we can place all these values, for example, somewhere here. We will add lines here, and we will be playing with numbers here. We will see the diagram, we will see how much financing we need, what is the simple, discounted payback period, what is the net present value of this business idea, what is the internal rate of return, and everything can be quickly seen during this scenario play. So this was the story about payback period. You may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video, I will give you the link to the playlist where I will be keeping all these tutorials. And when I will be done with this model completely, I will give you all the links in the description of this video as well, so you may watch all these tutorials absolutely free from the very beginning. So thank you guys for watching, see you next videos, thank you and bye.